if you compare investor-owned utilities to publicly owned utilities, their rates have not gone up. They've actually lagged inflation a little bit, at least on the residential side, I believe on average as well. So there is something about utilities, investor-owned utilities, financial incentives that's contributing to this, that publicly owned utilities, because they don't have those financial incentives, are sort of like, hey, I'm able to keep the lights on. I'm able to meet my environmental goals. My customers are actually happier than the investor-owned utilities customers. It's like, so, they seem to be able to do it at much lower cost. Like what, you have some explaining to do. I think, yeah, that's a very high level, but there's something real going on there, about how these dynamics are playing out and how they interact with the utility incentive structure.
Today's guest knows the utility business from the inside, and he's not afraid to call it out. Mark Ellis is a former chief economist and chief strategy officer at Sempra, one of America's largest investor-owned utilities. But these days, he's flipping the script. As a consultant, expert witness, and senior fellow at the American Economic Liberties Project, Mark is lifting the lid on how utility profit models distort incentives, burden businesses and households, and slow the energy transition. If you've ever wondered why your electricity bill keeps climbing, even as the cost of solar and storage drops, Mark has the answers. And more importantly, he has ideas for how we can reform and unlock a faster, more affordable, and just energy future. Hey, Mark, welcome to the show. As always, we love to get to know our guests. So can you tell us, what are you passionate about?
On a personal level, I'm passionate about my family. I have 4 kids. We have 4 kids. They're all grown between the ages of 25 and 19. And one of the things I really enjoy doing with them is traveling with them, either as a family or individually. I just came back from 3 weeks in Asia with number 3, and I'm about to head out on a little road trip in Northern California with number 2 tomorrow morning.
So awesome.
Yeah.
What's the Northern California plan?
He's in Palo Alto finishing up an internship, and he borrowed my car for the summer. So I'm going to fly up, pick up the car. We're going to go to Lassen Volcanic National Park, which I haven't been to since I was like, my very first memory of like traveling as a family was to there in Crater Lake. So we're going to go there and to Crater Lake, and also some lava tubes and do a little caving, and then just drive home.
Right.
Yeah.
So where did you grow up yourself, Mark?
I grew up in the San Fernando Valley, up in LA.
And were you adventurous and outdoorsy and loved traveling even back then?
So my family traveled quite a bit, but not so outdoorsy. Did a little camping. We had a group of families that we would go on camping trips with, but we had like a pop-up trailer. That, some of them had motorhomes and tents. But as our family, we spent a lot of time in like the national parks, particularly COVID and in the wake of COVID. So I've probably visited 30 of the national parks since the start of COVID. Some of them multiple times. Yeah.
That's incredible. I love that. Well, Mark, get us up to speed. You've had a pretty incredible career within the energy space. Get our listeners up to speed on kind of what you've done and what's brought you to where you are now, and then we can dig into some of the details.
Yeah. So I wouldn't necessarily consider it incredible. I've just been in the industry for a long time. For whatever reason, a lot of times in life, things just happen serendipitously. So I serendipitously kind of fell into the energy industry and, found some things to just really pique my interest in it and have kept me going all these years. So my very first job out of college, I studied mechanical engineering, and I ended up getting a job for Sanyo Electric in Japan, as a research engineer outside Osaka, which was an amazing experience to be, a foreigner in another country. So this is in like 92, 93. And what intrigued me about them is even back then, Sanyo was a company that was very interested in environmental things. So like in their lab, they were a pioneer, for example, in thin film photovoltaics. And in my lab, like the chairman had this vision of covering the world in a superconducting electric grid and using solar panels to export energy from like the North Sahara to Europe, and like having this global interconnected grid. Like they had this giant globe in our lab. I happened to work on refrigeration technologies, and at the time the big concern was the ozone hole. and the Montreal Protocol. So I worked on Stirling cycle refrigeration technologies that didn't use chlorofluorocarbons. That was what I worked on. But interestingly, in our lab, they had a research library, and they got these pamphlets from an organization called the World Watch Institute. And the World Watch Institute is like an environmental advocacy research organization, and they publish these pamphlets, like, I don't know, 50 to 100 pages, diving into different issues. About half of them were related to energy and the environment and, sort of the economics. And so this was back in the day when, like, Amory Lovins was first talking about, negawatts and things like that. Yeah. And the idea of utility-sponsored demand-side management was just sort of a glimmer in people's eyes and so forth. And I just fell in love with this. And, like, I read, every one of the pamphlets that had to do with the energy, economics, environment nexus. And basically over the course of that year, I was like, this is what I want to do with my life. What I loved about it was that energy is this thing that, like, if you don't have commercial energy, like, the world grinds to a halt literally within seconds, right? But we just take it for granted, right? And so, like, you ask most people, where does energy come from? And they're like, oh, that socket in the wall or the station down on the corner, right? They have no idea what goes on upstream of that, which is just, but then if it's like incredible that, a gallon of gasoline, at the time it was $1, right? But now it's $4. But if you think about what goes on, everything that goes on behind it, it's still a total bargain, right? And electricity, the same thing. And I just found that so fascinating. And in fact, I applied to graduate school at MIT's Technology and Policy program. And I still remember my opening sentence was, energy is the unsung hero of the modern economy.
Oh, wow.
We just take it for granted that without it, like, we don't get out of the starting gate without commercial energy. And so that's been a big driver of just, like, this is this vital part of the economy. It kind of goes, like, people notice it when they don't have it. But other than that, it's just this sort of in the background. So I really, that's kind of been driving me all these years. And then, I went to graduate school at MIT, and this was in the mid 90s. And so at that time, all the, the focus of in the community of people who were involved in this was, like, deregulation, introducing more competition, privatizing, publicly owned assets and things like that. And, wholesale markets and retail markets and all that stuff. So that's really informed my worldview around, like, hey, where you can have competition in energy markets, really that's, as long as they're well managed and sort of refereed appropriately, right? The rule makers that there are rules and that there are people empowered to enforce the rules, like and there's competition, like, markets work really well. And that's always informed my world, sort of how I think about energy and, the roles that I've gravitated to and the things I've tried to do in my career.
That's so good. You're speaking our language, Mark.
So interesting. While I was at Sanyo, I read in the international edition of Newsweek about the world's first utility-sponsored demand-side management program at Southern California Edison, like right in my backyard. So I wrote to them while I was in Japan, and I said, "Hey, I'm really interested in what you're doing, and I'm coming back to the United States. I'd like to work with you." And they said, "Well, when you come back, come and interview with us." So I ended up working for them for about 9 months between Sanyo and then going back to grad school. Crazy thing, again, serendipitously, that article was only in the international edition of Newsweek. It wasn't in the U.S. edition of Newsweek. So I ended up working there for a few months in industrial demand-side management. But a lot of it had to do with helping companies. It was paired with the AQMD was getting rid of volatiles for smog, like the stuff, the paint thinner smell in paints and coatings, moving away from that because those cause smog. In California is a big problem. So helping companies move from, solvent-based coatings to electrically cured coatings, powder coats and UV cured coatings and things like that with aircraft manufacturers and auto body shops and furniture manufacturers. Then I went back to MIT for grad school. There during the summer, I went back to Japan, and I happened to read the book The Prize, which is, you guys have to read that book. And I said, even though I'm studying electricity, I have to work for an oil company. So I ended up working for Mobil in their international gas and power project development group. Oh. And I did a lot of stuff. We were basically trying to build power plants in all these markets that were trying to introduce, like, bring in competitive capital, like either privatize or introduce more competitive capital. And so that was really interesting work. I went through the ExxonMobil merger, and then um, after the merger, a few months after I joined McKinsey, and had a really interesting run at McKinsey. The first real project there was we had a team working for Governor Gray Davis during the energy crisis, the first energy crisis in California in 2000, 2001. So we had a small team, and I was a junior member of the team, and we were advising the governor through the midst of that, and basically, helping him, one, reduce demand was one big thing, because obviously if you could reduce demand, that would have a moderating influence on prices and keep the lights on. And then how does he finance? The state stepped in basically for the utilities who were going bankrupt and was buying high and selling low. So it was building up this debt. And so how are they going to finance that debt over time? So those are the two issues that we worked on.
That has to be one
Then,
of the more interesting McKinsey projects of all time within energy.
yeah, Dave had meaning me. I can't vouch for that. It was an interesting project, and I learned a lot, and still keep in touch with some of the folks I've worked on that project. I was with McKinsey. So at the time I was in Houston, and my wife wanted to move back to California, and we had two kids, a third on the way. And she's like, enough of this traveling, and you need a regular job. And I want to move back to California. And sort of long story short, we ended up moving to San Diego, and I joined Sempra. And I worked at Sempra for 15 years, and I had a variety of different titles, but my main responsibility was like overseeing the strategy function for the parent company, not for the utilities. So I was always at the corporate center and had visibility into the unregulated side of the business, particularly when I joined, because that was the big growth area in the company, was the non-utility business, LNG and trading and gas-fired generation and renewables and pipelines and storage and things. So most of my work there was on the unregulated side. But some of the work I did was like helping the company understand, like, oh, this utility business that you think is like, particularly in the wake of that energy crisis, they kind of pulled in their horns. So they were very cautious, and they're like, oh, it's just this kind of slow growth, just earns its cost of capital business. That was the mentality. And I did a project in the wake of the financial crisis, like looking at cost of capital. And it was kind of like, that business that you think is just sleepy, just earning its cost of capital, that's the value creation machine. And over the next 10 years, they basically sold off almost all of their unregulated businesses and doubled down on their regulated businesses. And they went from the 14th largest U.S. utility to the fourth over the next 10 years. And the icing on the cake was they bought Oncor, which is the Texas distribution company, out from at the 11th hour, out from under the nose of Warren Buffett, right? And and then the plan was very much like, oh, we're going to buy this utility, and we're going to pump in a bunch of capital, and we're going to grow it. And I think they just announced it like a month ago. Their capital plan for the 5-year capital plan for Oncor is over $50 billion. And it's like, yeah, that was the intent from day one. Is like, and the truth of the matter, that's the intent with all utilities. Is that's how they create value. Is just it's literally as simple as it's as simple as a mathematical formula. It's like you put in a certain amount of capital, and it creates some multiple of that in stock market value, and that's it. It's pretty straightforward.
Can we spend a minute on that for our listeners? Can you just,
sure,
and in like simple terms, break down how an investor-owned utility or any other utility iterations from that, how do they make money? How do they think about 1, 5, 10-year plans and growth?
Right. Yeah. So the utilities are the basic model for utilities. Sort of, I'll describe first sort of the normative, how it should be, and then I will get into the descriptive, how it is. So I'm going to describe normative. So the normative standard for utilities is called cost of service regulation. As the name implies, cost of service, basically utilities are supposed to recover in rates their cost of service. And cost of service is defined as things, costs that are actual costs. Like, you can't make up numbers or say, oh, there's a shadow cost, right? It has to be a real cost, and it has to be prudently incurred. So if they're, buying expensive golf memberships for every employee, that's not a prudent cost, and you can't recover. That's not controversial, right? That's, prudently incurred costs you're allowed to recover. So what are their costs? So you can generally bucket their costs into two categories. So the first one is operating costs. And these are things like they just incur them on a daily basis or annual basis, and you kind of recover them as they're incurred. So that would include things like salary. If they have a power plant and they're procuring fuel, like the gas, right, would be the gas for the power plants, it'd be rent, would be their taxes, property taxes and income taxes, just everything that, sort of they're incurring on a daily basis. And basically the idea is whatever they pay, they roll it up and they pass it through into rates, and there's no markup. Like it's cost of service, not cost plus rate. It's cost of service regulation, not cost plus regulation. So they just roll that up and pass it through. But not all their costs. So not all their costs are sort of incurred and consumed at the same time. So they make capital investments, and for capital investments, they don't. They pay for them today, but they don't recover all the costs today, and they do that for two reasons. The first is that if they built a transmission line, it cost $2 billion, and they put $2 billion in their revenue requirement, then the rates would spike, and you can't do that to customers. So they spread it out over time. And the second reason why they spread out the recovery over time is if they made an investment and they recovered all of it today, then what's the incentive to maintain that investment over time, right? They'll just let it go to pot, right? And they won't maintain it. So you say, hey, as long as you can recover it for as long as it's expected to. You can recover the cost for as long as you expect it to be in service. So transmission line might be 30 or 40 years. And so this is not unique to utilities. All businesses have this, where they make an investment and they recover it over time. And it's called depreciation and amortization. So, and you can think of that as it's also a cost. And so the depreciation and amortization are the return of their capital, right? So they recover their cost over time. And so that's a chunk of that's a third chunk. You have the ongoing cost, you have the return of capital. There's a third cost, and we're all familiar with this because most of us have some kind of loan, and it's like a cost of money, right? Or the time value of money. Because you say, well, I'm only recovering it over time, but time has value, right? So if I'm recovering it over time, I get some kind of return on my investment.
Yeah.
And so that's the return on capital, right? That they're allowed to recover in rates. So you have operating costs, you have the return of capital, and you have a return on capital. So it turns out that the return on capital is where all their profit is, right? So because it's that time value of money that it's not necessarily observable in the way that the other costs are, that the regulator has to approve these. So I'm going to unpack just that return on capital component for a moment. So when utilities make an investment, they finance it with two sources of capital. And again, this is not unique to utilities. Virtually all businesses finance their investments with two basic sources of capital. They have debt, they take out a loan, and then they have equity. And we do this ourselves. Like when we buy a house, right? We get a loan, but you also have to have a down payment. That's the equivalent of your equity, right? So they finance it with debt and equity. And generally it's, give or take, but most utilities, it's around 50% debt, 50% equity.
Okay.
Right. And so then they're allowed to recover, again, the depreciation and amortization. And then, well, what's the cost of the debt? The return on capital for the debt is just whatever the bank or the bond market is charging them. So if they issue a bond and the market says that bond, $1 billion bond, 5%, well, that's what they get to recover in rates. Pretty straightforward. So the wrinkle, though, is what's the return on their equity? That's not something you can go look up. It's not in a contract, and you can't look it up necessarily on a Bloomberg screen or Yahoo Finance. That is something that has to be set by the regulator. Currently, that it's set by the regulator. And that's where all the rub is, because that return on equity is actually also their profit. In other words, you take the amount of equity and you multiply it by, they call it the return on equity, ROE. Return on equity times ROE is equal to their profit. Yep. And profit can go by several names. It could be net income, profit, earnings, has a variety of names, but basically the equity, the amount of equity times the ROE is equal to their profit. An IOU, an investor-owned utility, is a for-profit company. And like every for-profit company, they want to maximize their profits, right? So they have two levers to do that, right? They can increase the amount of capital they invest, right? That drives up the amount of equity. So, right, the profit equals equity times the return on equity. Yep. So they can increase the amount of equity, and they can increase the ROE. So they spend a lot of time focused on dialing those two knobs and turning them up as much as, to 11, right? In each case. So that's basically the utility business model. So I'm going to step back now and go back to, remember I said that the utility regulatory model is called cost of service regulation. So that applies, and I described like, okay, you're recovering their actual costs. The depreciation is based on your actual cost, like it cost $1 billion, and then they divide it over 40 years. The interest is based on the actual cost. The return on equity also should be based on the actual cost.
Yes.
So what's the actual cost? It actually took a couple of decades for like the legal system to kind of articulate what they mean by the cost of equity, like the return on equity should be equal to the cost of equity. But in the 40s, they basically said, oh, it's the market-based. In other words, it's what an investor would require, the return an investor would require on an investment of comparable risk in the market. And that's it. And the important thing is in the market. In other words, it's based on what they can get in the stock market, not what other utilities are necessarily earning or what Apple is earning or in terms of their return on their investment. It's what an investor like you and me in the stock market would be able to get if we invested in a utility stock. What's happening and what's been happening for decades is that even though that ROE should be equal to the market-based cost of equity, COE, regulators have been awarding ROEs well above the COE. And what that means, if the ROE is equal to the COE, then the stock market value of their equity, right, that shows up in their stock price, would be exactly equal to their investment. So if they invested $1 billion of equity, then their stock market value would reflect $1 billion in the stock market. That is the bedrock principle of finance. It's called present value, right? That's sort of like finance principle number one, even before risk versus return, right? Present value is the bedrock principle of finance. Nobody disputes that if the rate of return were equal to the cost of equity, then the stock price should be equal to the amount of equity they have. So we know that utilities trade at like actually, I think I just looked 2.25 times the amount of equity they have invested. And the only way that can be true is if the authorized rate of return, authorized ROE, is greater than the market-based cost of equity. So every day you're staring in the face, like you can go on Yahoo Finance and look up the price to book value of Duke or Sempra or any of these utilities, PG&E, and they're all well above 1.5 to 2.5. Some are in the threes. So you're stared in the face every single day in real time, like, hey, the regulators are authorizing these ROEs much higher than they should, than the law tells them they should. And everybody just shrugs their shoulders and says, yeah, that's how we've always done it. And I just think, well, how much is this costing customers? It's like real money. And I worked it out. It's about $50 billion a year nationwide. I just filed testimony. So California is doing their cost of capital proceeding right now. I just filed testimony last week, and so the utilities all asked for 11 to 11.75%, like outrageous, really high. And I calculated if it was the market-based cost of equity, it would save customers over $6 billion a year.
Wow.
That's a lot of money, right?
Yeah.
Just in California, it's $50 billion nationwide, $6 billion in California alone. So we're talking real money. It's about $300 per household on average across the country. That's just, in residential. Businesses are also paying for this. Big tech is paying for this. Everybody's paying for this. If it's an investor-owned utility. And it just seems like, hey, there's a lot of money here. And it's just even in the regulatory literature, they refer to wealth transfers. It's an unearned wealth transfer from consumers to utility shareholders.
So as a business leader, and I see my rates going up, and I think a lot of people don't realize that's like a compounding escalation effect as well, because it's 5% on the previous year being even higher than it was before. How is this justifiable, and where does it stop? Because we're in a position now where the grid is obviously needing a lot of investment, and it seems to have been underserved. How has the system been allowed to operate the way it has without also delivering the level of service that we expect and need and want to meet our ever-changing demands?
Yeah, so this is a really complicated question, right? So, because there's multiple parts to it. Like, how did they get away with this for so long? And then how are we going to manage going forward? And I think, to cut to the quick, the short answer, how we're going to manage going forward is like, it's not clear because the demands being placed on the grid today are really unprecedented. Like certainly, my entire career, like you can look at, the EIA data and look at, how electricity demand, virtually all economies, as they're starting out, electricity demand grows faster than GDP. And then it kind of tracks GDP for a number of years. And then eventually it grows slower. Like energy demand in total grows slower than GDP. So natural gas has been much well below GDP. It might have been stagnant or even declining in aggregate terms, certainly for commercial and industrial. I'm sorry, commercial and residential. Electricity demand has been growing, but much more slowly than GDP. And I think, the last decade until 2 years ago was basically flat. So this idea of like, oh, electricity demand faster than GDP, nobody working today has ever experienced
Yeah.
that. And then you compound it with, okay, the way the utility works is the rates are based on the historical investment, right? So you have two things going on. One, there's been a tremendous escalation in the cost of the equipment. Gas turbines, we're talking about how expensive they are, and you're accelerating the pace at which you replace, like the amount of new capital in the rate base. That ratio is increasing much faster than it ever has before, right? Ordinarily, it's like, oh, you're replacing 5% a year. Well, now you're going to be replacing, 20% a year, or not replacing, but adding 20% a year. So your rate base, like the dollar value, is going to be rising much faster than inflation, irrespective of this rate of return issue. Now, the rate of return issue creates a perverse incentive for them to sort of put that on steroids, right?
Yeah.
So that's why you have these like massive rate increases. You see it in particular in California, but the rest of the country is starting to see this as well. And that's kind of just, that's just the inevitable. The rate of return has two benefits. One is it just makes everything less expensive. So that ROE plus, because they gross it up for taxes. So if it's 10%, you're actually paying 14%. The customer's actually paying 14%.
Yeah.
Right. And it's not 14% of the bill. It's actually about 25% of the bill is this rate of return.
Mm.
Just their profit and the taxes on their profit is 25% of your bill. So, if you can cut that by 40%, which is about what their true cost of equity is, that's a material impact. That's about 10% of the bill right there, right? 25%, you take 40% of that, that's 10%, you're cutting off 10%. In addition, it removes the incentive for the utility because now when they add rate base, it's just one for one in their market cap. So they're just on a treadmill at that point, right? It's like I can raise $1 billion from investors and it turns into $1 billion in my market cap. And they're kind of indifferent. They'll still invest, right? But it's not like it's not like it's on steroids. It's just like you're earning your cost of capital. Just like the bondholders, they invest and they just get their expected return. The other investors are investing and they just get their expected. They'll still invest, but they're not going to get these outrageous returns anymore.
Yeah. It feels like this positive feedback loop that is just fulfilling itself. I mean,
just one thing, positive has a positive connotation. I call it a vicious cycle.
Okay. Agreed. Yes. I as I said it, I realized that it's not a positive thing. It's just fulfilling itself, a vicious cycle. I like that better. We've been looking at the data and to your point, for 20 years, it was relatively flat. But if you look at the rates, especially if you look at commercial industrial rates, similar time periods, 2016 to 2020, rates were pretty flat in commercial industrial, even came down a bit in industrial when you look at it, the average across the country. But then 2020 through 2024, you've seen this hockey stick.
Yeah.
I'm going to ask you to look in your crystal ball a little bit. What do you see over the next 5 to 10 years? Are we gonna keep pace? Are we gonna be on more of an exponential curve and it's gonna accelerate? Like what are you seeing in the data and the deferred maintenance and all of this vicious cycle?
Yeah. So I kind of have a view. I don't try to make forecasts. The best I do is like I'll read other people's forecasts and maybe say, here's the consensus of what other people think. I do think there's a number of dynamics that would suggest that, like, hey, rate increases are likely to increase for the reasons I gave, right? Just because, like you could say, I don't agree that all this demand is going to materialize, but I have some degree of confidence that these new sources of demand, particularly artificial intelligence, will net increase the rate of electricity demand growth. Is it 5%? 10? I don't know, but it's going to put increasing demands for investment, right? And that just through that process that I described before. Hey, if you're adding rate base faster than you have, if you're increasing investment in rate base faster than you have in the past, and it's driven by both the physical demand and also by the inflation in the costs, then rate base, that's going to flow through to rates, and rates will go up faster than in, the rest, than the cost in the rest of the economy. I think, but how much, I don't know. There's an interesting dynamic though. If you bifurcate, if you look at rates, it's not easy to do because you have to do the analysis yourself. It's not something you can pull from the EIA directly. If you compare investor-owned utilities to publicly owned utilities, their rates have not gone up. They've actually lagged inflation a little bit, at least on the residential side, I believe on average as well. So there is something about utilities, investor-owned utilities, financial incentives that's contributing to this, that publicly owned utilities, because they don't have those financial incentives, are sort of like, hey, I'm able to keep the lights on. I'm able to meet my environmental goals. My customers are actually happier than the investor-owned utilities customers. It's like, so, they seem to be able to do it at much lower cost. Like what, you have some explaining to do.
Yeah.
I think, that's a very high level, but there's something real going on there, about how these dynamics are playing out and how they interact with the utility incentive structure.
Yeah. And Mark, from your time inside the boardroom, having these discussions, we're representing business leaders that now want to take more control over their own energy outcomes and deploying behind the meter on-site energy systems. And now with the technology, you can beat utility power costs quite significantly and be saving yourself a lot of money. Back in the day, it felt like the utilities was working really hard to try and prevent this from happening. I think we're starting to see a bit of a shift as they realize that they need some spare capacity on the grid, and they're almost realizing that this may help them. What are you seeing in that market? What were the discussions being had? What are the barriers to adoption? And why would you be encouraging business leaders to actually go down that route based on the current state of affairs?
So this is an issue that in terms of the details that you're describing, I haven't looked at it at that level of detail, and I do know, the attractiveness of distributed energy will be very, very sensitive to sort of how the regulators structure it. So, for example, I'm NEM 1.0, right? So I got the best deal,
yeah,
right? But then they changed it, so the economics of solar for NEM 2.0, and I don't even know what the number is now. Like, it's very different. So, the business leaders that you're talking about, like, they have to look at very specifically, like, what's the investment, what's the rate structure, how might that rate structure change, am I grandfathered in? It's a very, very detailed analysis. I had a friend recently, this is about a year and a half ago, and he wanted to put solar on his roof, and he asked me to help him review the bids, and he got bids for solar and batteries, and then it was so complicated. I said, this is I had to figure out a way to simplify it. And he ended up saving a lot of money because I told him, make sure to get multiple bids and negotiate. I think the thing that was clear for him, that I made clear for him, is they're showing you solar and batteries and then just solar. And they're, you're saving money on both. But he said, but if you look at the incremental investment in the batteries versus the savings, you're actually losing money on the battery. So don't get the battery. They're showing you the combined and you're saving money, right? But you save more of just the solar. So just go with solar. I had to walk him through that. So I think that's an important thing, is you can't just look at, I'm saving a certain amount of money and therefore go ahead. So that's one point. It's going to be very, very specific to the installation and the regulatory treatment. And you could, as you described, sometimes the utilities will be very encouraging because, who knows what their financial incentives are on the back end, or regulatory incentives, or the constraints they're having. They want to do it themselves, but they just can't, and they can't afford, sort of operational issues. So they're like, yeah, I'm going to help customers get on the grid because I have no choice. So that's one issue. Another thought that comes to mind is when I was at Sempra, we did a study. This is 2013, and we looked at behind the meter storage for demand charge management. So familiar with that? Like commercial, like larger loads, they have a demand charge. And at the time, this was over a decade ago, it was like, this is in the money for a lot of different loads for like schools and hospitals and hotels that have kind of peaky loads and, and that are not like, they're not used every day and things like that. Right. And we were thinking like, this is a potential death spiral because it was in the money then. We knew where the demand charges were going, where the battery prices were going. Like, this is just going to get worse. And then as customers defect, right, then the remaining, distribution costs have to be put on other customers, and that causes the spiral.
Yeah.
And we saw it actually play out where battery installations were pretty high for a number of years and then it just stopped. And to this day, I still don't understand, like, why isn't behind the meter batteries for demand charge management for, any customer that has a demand charge? Like, why isn't that just the killer business? I don't know. It's not an issue I spend a lot of time on. I focus more on the macro, utility finance model because that's just my thing. But that was just an interesting analysis we did, and we were just like, we expected this to happen, and it never. We did a lot of other stuff on like EV charging and batteries for like bulk batteries, and like we couldn't get the numbers to pencil out, and we saw like those are going to be challenging. Like you need a dramatic change in the cost structure. But this was one that was like, this makes a lot of sense now. And it just never. So maybe among your listenership, there's somebody who's like, I got to look at that again and figure this out.
Well, we're seeing it all the time, and it definitely makes a lot of sense. And I think, to your point before, I think the biggest barrier to adoption is just the complexity of it all, because the average business leader specializes in what they do best, but they don't really know energy. And that's where we're really trying to support the industry to cut through that complexity, understand the tariff structure, the technologies that should be deployed, what the financial trade-offs are, because this is it's overwhelming for people.
Yeah. I think my gut reaction is like, there was so much margin, right? Like somebody can come in there and it's like, let me just put it in there and, you're going to save a certain amount and you give me half of your savings. Somewhere like, all you have to do, you have to provide a pad in somewhere, and I take care of the rest.
Yeah.
Make it really simple. And all they see is like, oh, my bill went down. I'm like, that's it.
Yeah. Well, at the same time, leaving a ton of value for themselves on the table in some of those cases too. One question I had, and I'm curious if you have any perspective on this. Occasionally, see chatter in the industry that, especially over the last several years, with the growth of solar and wind, and now we've seen more so like utility scale battery energy storage. I'm talking utility scale at this point. That being the culprit for rising rates. What is your perspective on that?
So again, this is not an issue that I've necessarily done all the analysis and unpacked, but you can look it up. Go look at the contribution of a typical rate or the utilities revenue requirement of the generation versus the T&D.
Yep.
Right. So, and which one is growing faster? So for example, go look at the EEI financial report, and they show like where the CapEx has been going over the last few years. How much in generation, how much in distribution, how much in transmission and gas as well. And it's the T&D that's growing faster than the generation. And keep in mind, remember the generation part is going into the capital intensive, low operating cost renewables, right? So you can't say, well, the generation is bigger because you're not accounting for the fuel. No, remember, you're putting it in things that have no fuel cost. So I think that this is, anything that has a political angle, like people jump on it because it immediately attracts attention. But I think it's a bit of a red herring that, it's the renewables policies. There are issues of renewables policies that are driving up costs. Let's not ignore that. And there's issues. I personally have a lot of concerns that, like wind that is incentivized to run even when it's losing money because of the tax credit, like that on its face is not an efficient use of capital, right? Right. Completely it's agree. Like you're paying somebody to do something that actually has no market value. Like there's something wrong, perverse about that. But let's put that to the side. Let's look at the real culprits here. And I think it's it's not the whole. I mean, wholesale markets probably in certain instances are the problem, and it's the generation. But I think as a blanket statement, I think the T&D is a bigger contributor than the generation cost. And again, you see this at the muni level where their rates are not going up as much. They're not putting as much capital into their grids because they're more prudent with how they spend money.
Yeah, exactly. And so, Mark, you've obviously been thinking about this a lot, and you're working on ways to counter and challenge this market dynamic. Talk us through what you're
Yeah.
working on. What's the solution for this? How do we dig ourselves
Yeah.
out of this hole?
So I kind of wear three hats. So originally, so I like this describe, I was, in the industry for almost 30 years. And then I crossed the Rubicon and now I work primarily for consumer advocates, although I started to engage a little bit with the environmental community. The Sierra Club sponsors my testimony in California this time around, which I'm so thrilled about. So I wear three hats. One is I do expert witness work on behalf of consumer advocates and regulatory proceedings, and that's kind of like my core work. And then the other two things I do is last year I joined anti-monopoly advocacy group called the American Economic Liberties Project, and I'm their senior fellow for utilities. And what attracted me to them is um, I'd go around banging this drum about utility profits, right? And like nobody would listen to me. I'd go to NASUCA, the consumer advocacy group, and I made presentations there. And I'd go to environmental groups and don't you want to reduce customer costs? Don't you want the energy transition to be cheaper? And there just wasn't a lot of receptivity. And I was just like, who cares about monopoly abuse? Like this is just classic monopoly abuse. And I went to this organization, and their big thing was like big tech and pharma and airlines and things like that. And I said, you're focused on these de facto monopolies, companies that started out very competitive, but then became monopolies like Google or Facebook, right? But I said, with the de jure monopolies, the ones that we like, everybody knows they exist and we're all okay with it. I said, the abuse is just as bad, if not worse. And so we had a number of conversations, and they eventually brought me on board. And so ended up writing a paper in January, published a paper called "The Rate of Return Equals Cost of Capital," and that kind of like brought kind of introduced this issue to a broader audience, and it's gotten some nice attention. And so the second hat I wear is more in the advocacy realm and trying to educate policymakers and consumer protection groups, consumer advocacy groups about why you should care about this issue, this arcane issue that's in the bowels of the regulatory process that even among the regulators, few of them care about. Why you should care about this, because it's $300 a year in your electric bill, right? So I've been working on that, and we've had some success there. A couple of things. One of the recommendations in the paper was passing state-level legislation that codifies this rate of return equals cost of capital standard. And it was modeled after New York. There was a bill introduced in 2023 to do just that. And so I said, this is a great idea. Do it in other states. So now 5 states have introduced legislation. It's going anywhere, right? This is a long political. I shouldn't. That's probably overstating it. It's a long political process, and it's not like, oh yeah, there's a law that's passed. But to me, it's really interesting that it's on their radar screen. Interestingly, one of the bills in Florida was introduced by a Republican. So usually you think this is a Democrat issue, consumer protection, but it's introduced by a Floridan in Florida by a Republican. He's probably like, hey, there's a lot of retirees on fixed income in Florida, and their rates are going up, and that's not right. Another interesting angle is we've gotten a lot of interest from federal lawmakers, which you would think, like, what do federal lawmakers have to do with any of this? They don't have jurisdiction over the PUCs, but they're like, my constituents are pissed at their utility. Their rates keep going up, and the regulator and the consumer state regulator isn't listening to them. And so I'm going to do something. And in fact, one of them intervened in a rate case, and he cross-examined the utilities rate of return expert. Nobody's ever done that. No state regulators ever cross-examined a rate of return expert. And to me, like, that's just awesome. So that's the second hat, is the advocacy and the anti-monopoly advocacy and trying to bring greater public and political awareness to this issue. And then the third hat is I want to solve this problem. I don't just want to like tilt at windmills and say rate of return is too high. And so I mentioned I went to graduate school in the 90s, and the whole big thing was about, introducing markets, right? Regulation is a surrogate for competition. So where you can't have competition, you should. And we see Texas has competition at the retail and wholesale level. California has competition at the wholesale level. Many states have competition at the wholesale, at least at the wholesale level, and often at the retail level. And, whether it works or not, that's debatable. But we know competition in general as a concept tends to reduce prices, improve quality, and so forth. So what I'm working on is introducing competition into the utility monopoly over the provision of equity. So the basic idea that going back to the early days, like when Thomas Edison's business partner, Samuel Insull, created the utility monopoly model, they basically said, they granted the utility a monopoly, an operating monopoly, because it doesn't make sense to have multiple lines running down the street. But in addition, they bolted on a financing monopoly, right? I talked before about they raise debt and they raise equity. But the financing monopoly is only for the equity, not the debt. So the debt, when the utility needs to raise debt, they go to the market. Just like you and I, when we go to, finance our house, we get multiple bids. And no utility would ever think like, oh, my parent company wants X%. That's what I'm going to request to the regulator. It's just a given. Of course you go to the market. But for the equity, it's just like, oh, I'm going to go ask my parent company told me to ask for 11%. I'm going to go ask for 11%. And then we're going to negotiate around that. And you don't need to do that. You could say, like, why don't you put it up for bid the same way you put the debt up for bid? And we've been working on this for a couple of months, more than a couple of months. And we're talking to, potential investors and so forth. And it's like, there's a huge demand for what I call competitive direct equity. In other words, the idea of investors investing not in the parent company, not in Sempra or in NextEra, but in SDG&E or SoCalGas, providing the equity directly to them or directly to FP&L. And just saying like, hey, you want to raise equity? Just who's going to give you the best price? Just like you do for debt. So that's the basic concept. And it kind of has it's one of the few things a regulator could do that can immediately dramatically reduce rates, right? That cost of capital, remember, I said it's about 25% of the bill when you include the taxes. And we think you could reduce it around 40%, 30 to 40%. So take 25% times 30 to 40, that's 7.5 to 10%. That's real money, right? That's, a couple $100 a year for every customer, for every household in the country.
Wow. And is that going to, like, driving this shift and this change, would that require a bunch of, new bills and acts at a state, federal level? Like, is it going to require a huge regulatory shift?
I think it kind of huge regulatory shift, but not I don't think a legislative or legal shift. I think this is something that because the regulator requires the utility, when they buy insurance, go get bids. You should go get bids. When you buy a fleet of trucks, go get bids. There's nothing that says like, oh, when you raise equity, you have to go to your parent, right? Like there's no, like that's just what they do. But they could raise equity wherever. They could raise equity wherever they want. Now they want to raise it from their parent, but so the regulator could direct them like, go do a competitive auction for this. They're going to fight it tooth and nail, right? Because that's, like I said, that is their profit engine, right? It's the ROE times the amount of investment. But this is the basic idea that it's less around a regulatory change or a legal change, legislative change, then it's like all politics, right? It's why let's just step back. It's like we've had this long-standing problem of the rate of return that's too high. It's not a mystery. This is like finance 101. People have been writing about this problem. World-renowned economists and regulators have been writing about this problem since at least 1970. So there was a very famous economist named Alfred Kahn. He was the deregulation czar. He was the guy who started the whole deregulation under President Carter. So it started with like airlines and trucking, and eventually it percolated away in telecom. Like the internet would not be what it is without his work breaking up the telcos, and worked its way to electricity. He wrote about this, and he has a famous textbook. He wrote about in 1970, like, hey, these rates of return, the rate of return is too high when the market value is greater than their actual book value investment. Like he says it that clear. And it's just a matter of fact. It's not like some new theory. It's just a restatement of Finance 101. So then if this problem has persisted all these years, like clearly there's, and it's not rocket science, and it's staring you in the face when you go on Yahoo Finance, tells you there's something like there's something wrong in the system. And this system is very political, so you got to figure out that. And that's the tough nut to crack. Here's the interesting thing. I mentioned this guy, Alfred Kahn. You know who else wrote about this issue? Peter Navarro,
Oh, really?
the Trump advisor. Peter Navarro wrote a paper for the Department of Energy in 1980. He talks about the same problem. So this is bipartisan. Everybody knows that, hey, this rate of return issue is a problem, but it persists because so there's a vested interest that makes a lot of money, $50 billion a year. It's $500 billion or more of market cap for them. And they keep it sequestered, and they sprinkle money around to silence critics. And so that's the bigger issue, is like, how are you going to address that? And we're doing a lot of thinking around how we're going to deal with those issues. The good news is that there are 50 states, right? So you got a lot of different venues, and plus you have the FERC. So there's a lot of different opportunities to try this out, and it just takes one to prove the model.
Yeah.
Because once you show, like, hey, we reduced the cost of equity dramatically, the credit rating was fine, and we didn't talk about that, but it's entirely like we can do this we can improve the credit rating. Like, that's always the utility's objection. If you do lower our ROE, it'll impact our credit rating, blah, blah, blah. Total red herring, and we can address that. So the lights stay on, the credit rating's fine, and costs are dramatically lower. And it's like, well, what's another, when you go to another state and you say, look, we can do this, we proved it, regulator's going to say, no, the incumbent's money's greener.
Yeah.
Like, I want them to continue fleecing customers to the tune of billions of dollars a year because, they wear nice suits and they buy me, they take me out to nice steak dinners. I mean, it's just, it would be very hard for them at that point to say, no, I just want to keep fleecing customers, allowing the utility to fleece customers.
And I imagine up until now, it's just because energy has not been a significant enough cost for people to have paid attention to, but now it's becoming significant enough. I imagine it's starting to hit more people's radar. And Mark, like, if you've obviously got the ear of commercial industrial business leaders through the podcast, would there be any ask of industry in support of this? Can they be advocating for this? What can they be doing to try and drive some change?
Yeah, so that's an interesting question. And, I mentioned before, like, hey, when I was first getting into this, and, I'd go to different groups, and I tried, you would think, industrials would have a vested interest in this. And they do in California. And I just also participated in Virginia. And you see these large commercial and industrial users. So in Virginia, like Amazon and Microsoft and Walmart, they all participate in the proceeding. Their interest, though, is generally, I call it the beggar thy neighbor strategy. It's like, oh, you're raising this revenue requirement, just make my slice of the pie smaller, right? And this is really like, no, we're going to reduce the cost for everyone, right? And your slice is going to get smaller too, but they're just focused on their narrower self-interest. But everybody pays this, right? If everybody pays a T&D charge, even in deregulated market, you're still paying that wires charge. Well, the wires charge, it's not 25% of the rate, it's closer to 50% of the rate is this rate of return. So maybe not 50%, maybe it's 30 or 40%, but it's a big chunk. And it's like, they should have a vested interest in this. My sense is that, like, big tech, they want to make their slice of the pie smaller, but they're not going to go after the profits, because at the end of the day, they just want stuff built now. And they're like, if this is perceived as impeding their ability to get stuff built, I don't want that. So I would love for them. I think there's very strong arguments on national security grounds and so forth that we should reduce the cost of electricity in this country, and that everybody has a vested interest in that. But there's like a collective action problem, right? So everybody, various parties don't want to antagonize the utility. So as long as I got mine, I don't care what happens to everybody else. So, there's also the issue, like big tech, they play utilities against each other. So they cut special deals, and so they don't want to antagonize them. Interestingly, big box retailers like Walmart, they can't play utilities against each other. They have to build wherever their customers are. And they actually participate in rate of return proceedings, but they're not aggressive. And I've never understood why they're not more aggressive. I think it's also because they're focused on the tariff issues and less on the rate of return in general.
Yeah.
So it's a bit different. I would love for more industrial support and focus on this issue. I know some industrials in Texas and elsewhere do participate in a rate of return, but frankly their testimony is just really weak, and it's not helping their cause.
Yeah. And it's not, to your point, it's probably, it's focused on their slice, not the system as a whole.
Yeah,
Um,
yeah,
and to your point on T&D, I think we see that you mentioned Encore earlier, but their rate case, I mean, that is T&D. That's all T&D, right? That's what
yes,
Encore does. And so that
that's all they do.
we're seeing
Yeah,
that in a very, very confined example.
yeah, yeah.
Well, Mark, I'd love to start to shift to our power surge round, and so
Okay.
let's kick it off with if you could be any one energy technology, what would it be and why?
I did a lot of work when I was at Sempra on storage, but natural gas storage. And then, of course, all the frameworks and like how to understand the economic value, particularly trading around storage assets.
Mm,
Um, so I've always been fascinated by these assets that have like what they call real option value. So storage, battery storage is like the epitome of that. Um, like high deliverability storage. So I guess that would be, and I think that value element of it isn't very well understood. And interestingly, data centers have a lot of that real option value as well, particularly if you have networks and you can shift load from geographically. As you think about it, like what business can do that, can arbitrage electricity markets geographically? Like certain business can arbitrage gas markets geographically, but nobody can. It's very hard to do it. Only data center, and this precedes the AI, right? But just data centers in general, like they could preferentially, as long as they're not fully baseloaded, they could preferentially shift their load. It's not easy to do technically, but various researchers started writing about this in like 2010. Um, so that to me is very intriguing. Just the real optionality of batteries and other assets. But batteries are like the epitome of real optionality. Part of the challenge of this is like just old school rate making 101, cost of service regulation. It's like the most basic. People ask me like, what's new? I'm like, no, there's nothing new here. This is all, like I said, they've been writing about this since 1970. But just understanding under how rates of return are set. I think the other interesting thing that people might find worthwhile exploring is, well, what is the market-based cost of equity? And there's a lot of nostrums, particularly if you read financial news, like, oh, you can make 15% in this, that, or the other. But when you look at what professionals, people who are like in the market, investing trillions of dollars of other people's money, like what is the market-based cost of equity for the market as a whole? It's like 6 to 7%. Go look at BlackRock's website right now. Go look at Vanguard's website right now, Goldman Sachs website right now, and you'll see they publish their own internal long-term cost of equity estimates. And I don't think I'm smarter than all the researchers at Vanguard or BlackRock or Goldman Sachs, not by any means. I don't have any insight. There's no way I have any insight that they do. Utilities are lower risk. Nobody denies that utilities are lower risk. So their cost of equity is somewhere below 6 to 7%. Right? Has to be. But in utility land, the utilities just came in saying, no, ours 11 to 11.75%. It's like, really, your experts are that much smarter? JP Morgan, BlackRock, Goldman Sachs, Vanguard, like all of them combined? Really? Like it's just preposterous, but they get away with this. Like it's on its face, it's just absurd. And they get away with it. So it would be, for people who are like curious, go spend some time on these websites, BlackRock, research affiliates, Vanguard, Morningstar, and you get a sense. And like it informs your own personal finance and like what you think you can expect from your own personal investing. And, kind of give a dose of reality to all of that. Well, here's the thing: is you're still with utility. You remember they're bidding up the price. So if they're paying twice book value, then you're not getting that 9 or 10% return, right?
Yeah.
It's complicated in terms of, well, where does it actually show up? It gets shown up in the bidding up of the price. But in any event, if you were to invest today, you're not going to get that 10%. You're going to get 5.5, 6, 7, 5.5, 6%, somewhere around there. But yeah, I think that's kind of another interesting thing. I mean, in terms of learning more about the rate of return, I mentioned this paper. It's on the American Economic Liberties website, and there's been some articles in the New and the I'm sorry, not the in the LA Times, San Francisco Chronicle, Inside Climate News on this issue. Politico has written about this, so it's starting to get some traction. But it's like literally, I say like a first year MBA student would look at a regulatory proceeding and understand like this part of it, the cost of capital, and understand what's going on, and two, say like this is just wrong. Like
Yeah.
this is not what they taught me in business school.
I think
Yeah.
the call out is not necessarily for all our listeners to go look at those BlackRock and everything. It's the regulators. I don't blame the utility folks for asking for it. That's their business, right? It's the regulators
Yes.
that are approving it. That's
Yeah.
the problem.
Yeah. Yeah. I mean, just one example of how sort of broken it is. Go on. So NARUC is the organization of regulators, the National Association of Regulatory Utility Commissioners, right? So that's their umbrella organization, and they have all these quarterly meetings and big. Go look on their website, look at their annual meeting. Go look at the list of sponsors. You had to guess, who are the sponsors?
It's all the utilities.
Edison Electric Institute and American Gas Association. It gets worse. There's another umbrella organization, an organization of organizations, because almost every state has a government agency that's the consumer advocate just for utilities, part of the Attorney General's office or part of the PUC or Department of Commerce. Go look at their annual meeting. Who's the sponsor? For the consumer advocates, Edison Electric Institute and American Gas Association. Like, this is like screaming conflict of interest. And it's like, that's just accepted.
Yeah.
Like,
Interesting.
Something's wrong.
Yeah. Mark, this has been a very interesting and eye-opening conversation. We really appreciate your time. We always like to close out with getting to know kind of where you see your success. And so if you were to finish this statement, what would it look like? In my life, I will have been successful when?
So I mentioned before when I'm passionate about my family. So I'm successful when I'll talk personally and professionally. Successful when I have kids that I look up to, right? Because usually you're like, oh, I want my kids. No, I have, and I'm fortunate. I'm very, very blessed to say, like, all of my kids, there's attributes in them, like, oh, I wish I was more like them. So that's to me, that's like huge success. Professionally, it's like I want to solve this problem. Like I was on a call with a investment analyst, financial analyst who covers utilities, and and he wasn't really getting into the whole rate of return. He's like, oh, you're just being dogmatic. And I said, look, I want to solve this problem. I'm not just tilting at windmills, right? I want to solve this problem. And it's a solvable problem. That's why I like it. This is a solvable problem. It's not like, oh, I'm going to decarbonize the grid. Like that's a solvable problem, but that's a generational problem. This you could solve in decades. This is a solvable problem. And I think leveraging markets and demonstrating, like there's financiers who would want to invest. So you got the investment community behind you. You've got consumers who would like to see this happen. You've got a certain group of politicians, not all, and a certain group of business interests. So you got this nice alignment of interest. Like this is a solvable problem. So that would be success, is like solving this problem of reducing the rate of return, and ideally through competitive capital markets. I think that's the ideal solution.
Capitalism at its finest.
Yeah.
Love it.
Thank you for having me on. This was a lot of fun. I really appreciate it.
Dan, I'm jazzed by that conversation. It was technical and financially mind-bending for me as like a non-finance expert, but like really insightful. And I think everyone should be aware of what's going on.
Yeah, it's a broken system, and one in which everybody, businesses, consumers, commercial, industrial alike, are subject to the ramifications of. I think the thing that stood out most for me is he continued to hit on the fact that competition is critical. And in the absence of competition, due to the monopolistic or regulated monopoly nature of many of these utilities, regulation serves to that role of competition to keep them in check. And it just had me thinking about the fact that whether companies have facilities in regulated markets where there's just one utility that they can consume from, or even in deregulated markets where they have retail choice and they can choose from a variety of different providers, it doesn't mean that that is the only competition that is there. Really, what you're trying to do is you're trying to power your loads, whether that be machines that build widgets or freezers that keep food cold. You're trying to get electrons into those systems. And another form of competition is being able to produce your own power and have that feed the machines that you need to serve. And so I think that that's an important bit as we continue to move forward, is that whether you can choose from a variety of different utilities or not, there's other competition out there to bring your costs, your emissions, your reliability into a place that is better for your business.
Yeah.
How about yourself, Guy?
Yeah, for me, I think I love that he touched on early that energy is the lifeblood of business, and without it, everything grinds to a halt super quickly. I think the sad reality is we can't really blame the utilities in this situation, can we? Because the rules of the game are kind of broken and they're operating in their stakeholders' best interests. But it just shows there's a complete misalignment between the generator and distributor of power and in this case, what they would consider to be their ratepayer, not even a customer. And I think this is the missing link, isn't it? How do we tie performance and quality of service to price instead of just this guaranteed return, and a return that isn't even fairly calculated? And so, yeah, I really like your point that you need to control your own destiny and not be reliant on a system that's actually tilted against you and isn't operating necessarily in your best interests. And so I think that's the big takeaway for me, and what most business leaders need to reflect on is, I really hope Mark is successful, but I think he even said this is probably a 10 plus year play. And so this isn't going to happen anytime soon. And the grid is in such a state, and it's only just beginning, that I think the cost escalations we're seeing are only just going to accelerate.
And even if and when Mark and his team are successful, it's not going to bring rates down. It's just going to slow the growth.
Yeah.
And I think that's an important one. So if it does take 10 years, we've got 10 years of growth ahead of us before that growth stops accelerating and just grows at the expected rate of return. And I think it's a really interesting one. You made me think of an analogy in the healthcare world, one where they're starting to see shifts away from just services rendered to one where they're focused on patient outcomes. And there's a growing kind of industry of what are called accountable care organizations they're not measured on the number of visits or surgeries or services provided and profit from that, but based on the actual health of a population and maintaining that health and taking proactive measures, and that's how they actually make money. And I think that if we can have our utilities measured based on the affordability and the service provided, as he was talking about, versus what the reality is, we'd be in a much better place. But it's a big ship, arguably the biggest ship to turn in all of mankind, and it's not going to happen quickly.
No, great conversation though, and I'm looking forward to following his work.
Likewise.
All right.
See you guys.
Cheers.
We receive a lot of questions from business leaders around the world wanting to learn more about the energy transition, what is possible, and where to start. So to help you stay informed and up to date on best practices, opportunities, risks, and success stories, we created an industry newsfeed at VECKTA.com/news with all our podcasts, blogs, and newsletter. Check it out and connect with Dan, myself, and the VECKTA team to learn more. Cheers and have a good one.